the CEO of Prosper Trading Academy, Scott Bauer, to the program. Scott, always a pleasure. Couldn't think of somebody better to have here on a Friday than yourself. Hope you're having a great morning. Talk to me about what your first thoughts are. Tie it into CPI if you want as well.
Thanks, Alex, and good morning to you and Jenny as well. What my thoughts are next, okay? When I say next is, okay, it's out. What are we looking at next? It's probably earnings. But this report, as Jenny said, the biggest component here that I see that stands out is energy. But if you take out the volatile food and energy part of this, we're kind of right in line, right? So you take those out, PPI is right in line. So what concerns me a little bit, and I'm glad that we're not seeing a big market reaction. We are seeing a little bit of a positive reaction. But what concerns me most is the energy part of it, which we know was, based into this report. We've seen energy prices falling a bunch. Well, next month, we're likely to see the opposite, given what we've seen in the prices of crude over the last 3 or 4 weeks. So, this is on the heels of CPI. CPI does garner the headlines here. This is a positive for the market, especially in the bond market. I can't believe that we have seen the 10-year rally. It was all the way up to 410. 410 before this print here. It's down around 408.5 right now. But what this tells me, Alex, is the market seems to be healthy overall. The fact that the market can withstand this big move in rates, and here we are still near all-time highs, something's got to be going right.
What do you make of the move in rates? Obviously, it's been a bit of a normalization. You've sort of seen the catch down in some of the really shorter term things, particularly the Fed funds, obviously, with the cut. But you are starting to see a little bit of that bear steepening in the longer end of the curve. Do you think that's more of a reflection of maybe that pendulum swinging too far, on rates to the downside, and less so maybe a runaway move to the upside here? Said another way, do you think that this Treasury sell-off can continue much beyond what it has already?
No, actually, I don't. And in fact, we took some positions yesterday that would be opposite of the move that is going. We've actually been long in some TLT, TMF, meaning that we're looking for rates to pretty much stabilize or actually come down and bonds to get bid up a little bit here. So I think we've seen a very violent, and I will call this violent, because to see, the 10-year go 360 to 410 in a matter of weeks, that is huge. I think it's an overreaction. I think the anticipation of the Fed cuts that we saw, which drove rates down, that's gone. And usually when we see a big event coming up, whether it's Fed meeting, whether it's earnings, there's usually this anticipation built up. And then when the results come in, we kind of see things temper down a little bit. And I think that's what we're going to see with rates here as well.
We talk all the time about seasonality when it comes to equity markets and risk around this period of the calendar. I've been saying, it's actually more prevalent when you look at the Treasury market. It does seem that there's a bit of a September kind of risk-off period in Treasuries consistently over the last few years as we kind of close out that period of time sort of in this mid-October range. So perhaps something like you're talking about, that tactical positioning, kind of counter this recent move, could make sense. Perhaps, too, if you think it's just been too far too fast. When you look now going ahead now, as you said, on to the next one when it comes to some of this data, we get sentiment later on this morning. But what's really on your radar? Is it going to be earnings or what is next for Scott Bauer?
Next is earnings. I mean, my next is not a month, 2 months, 3 months from now. My next is, what is happening in the market later today, early next week, and it is squarely focused on earnings. We get the big banks. We've got, JP Morgan, Wells Fargo that are out, and there's, I would say, some kind of whisper high expectations for earnings, even though earnings estimates have come down a little bit. And that whisper, what I mean is, people are still looking for guidance to come in really positively. And if it does, Alex, I think that's what can catapult this market to even bigger highs. And by the end of the year, we see another breakout in the S&Ps. But it's squarely all going to be on guidance. And what that's going to come down to is, what are these companies, from financials to consumer discretionary, what are they saying about the consumer, especially coming up to the holiday season? That's the big one for me.
Yeah, and when we look at this, I was talking a little bit about this with one of our guests earlier on in the program, Scott. I'd like to get your thoughts on it. We've sort of seen different performance than we have seen for much of the last few years, where you had sort of this isolated mega cap tech-driven rally, and not to say Nvidia and some of these names haven't made comebacks and aren't near highs again. But we've got broader participation. I can say that just by seeing the S&P 500 at highs and the NASDAQ 100 not at highs. What's that next catalyst? Is it big tech reasserting itself, or is this healthier just because we got other names participating?
I think it is healthier, and that's what we want. Sure, everybody likes to see big moves, and everybody, is counting on big tech to come back. For me, I would rather see this broadening out. I would rather see where we can look at different sectors and say, you know what? We're healthy here. We're healthy here. This sector is participating here. For the overall health of the markets, I think that's a great thing. Now, how does that, translate into what's going on Main Street and the economy? That may be a big difference. That, there may be a dichotomy there between the two. But for the markets, broadening out is always a good thing. And if we continue to see that, whether tech is the leader or not, that's why I think we can absolutely continue this and get all-time highs going into the end of the year.
Yeah, and it seems to be a more of a consensus feeling, to be fair now, and you can understand why. I mean, earnings have consistently been better than expected. The inflation situation, while maybe it's not at the 2% mark yet, Scott, overall, it's certainly closer than it was, and that trajectory continues to be lower. The labor market, even with this, noisier jobless claims print that we got this week, has still been a lot more resilient than I think pretty much anyone thought. When you look for risks, what are they? Is it going to be a surge in inflation? Is it the labor market? Is it misses in earnings? What keeps Scott Bauer up at night, if anything?
Okay, there's two things. One, I will tell you, which is not a risk to me, is the election. The election is the election. Whoever wins is going to win. And historically, that's not going to affect the market. So that is not what's keeping me up in terms of the market. Two things are geopolitical risks, as we know, is a hotbed right now, and things can really expand at any time, and things can maybe get better. That's what we all hope for. So that is number one. And then number two, when we look at guidance here for earnings, that is front and center to me. I would like to see guidance that is pretty much just in line with expectations and no big outliers that say, oh, we can see the consumer is really getting weak. We're lowering our guidance. So those are the two big risks to me. The former, the Mideast, the geopolitical risk probably takes second fiddle for me right now to what earnings are going to say. But the way we're moving right now, the way that the ecodata has come in, even with, as you said, the outlier yesterday we got with weekly jobless claims, things are actually looking pretty good, Alex.
It's hard to argue with that. Even if you want to, and you want to be bearish, and you want, which no one really wants to be. I guess that you think
it's a hated
the
rally.
market is overpriced or whatever the argument may be. I mean, the things to point to are fewer and farther between as we go forward. So we'll see where things shape up. A great analysis and thoughts as always, Scott. Have a great weekend, and thanks for joining us,
You
CEO
too, Alex.
of Prosper Trading Academy.